in order for you to actually lose a 1-to-1 of max profit potential on the trade. So again, probabilities extremely low. If you want to know about, what I mean by probabilities, just look on over here at the deviation levels, and you'll see those probability levels. So you'll know instantly just by looking at them what is the expected range, and we have to put that up there. The expected range on $CAD for today is 51 pips. Okay. Well, how accurate has that number been? Is that something you'd actually want to consider? Et cetera. We go here, we look at $CAD, pull it up, and we'll see how far has it actually moved. What was that on the deviation levels? If we go and plot those deviation levels on there and look at it, then we can quickly see, we got a +1, it pulled on back, and see right there, there's that 50 pip deviation move. Pretty much hit it, pulled right on back. So that's implied volatility-based deviation levels, okay? And that should help you a lot when you're trading because it gives you accurate expectations of how far the market's going to move on any given day, which is great for news days because, we do, like that news is factored in because we're not using historical information for calculating these implied volatility levels. We're actually looking at the deviation from the implied volatility of the options market, which is saying how far they're saying that the market is going to move at this given moment. Okay? And that's really the best way that I know to possibly do any kind of trade is to use market expectations, not just my expectations. So market expectations obviously have a lot more accuracy to them than anything else that you can come up with because it's the market telling you how far the market is actually going to go. And I use these, not only do I use implied volatility, I use expected range levels on any given minute to look at potential high profitability trades, different trades like that. I'll even do like reverse premium collection trades where I'll do what I call trend trading collection. So I'll look at a trade like this. I'll go, hey, is there volume? Is it breaking out of the expectation? Could I maybe sell the 1300? Could it move down a point? It might. If it breaks this low and I get a chance to get in the trade, I could have a really high profit trade. So using expectations, proper expectations, can add up to a lot more accuracy in whatever trading strategy is that you're choosing to execute. Not using that can lead to you just sort of putting your thumb in the air and seeing what way you think the wind's blowing. And we all know how well that works. So, you want to have something that's objective, that's outside of you, that says, hey, how far should I really expect the market to go any given day, any given hour? And that can help me be a little bit more realistic when I see that massive risk, like $30 to, make 35 to risk 165. Well, I'm going to make 35 on the other side, so now I'm down to, a lot less. But again, to lose that max amount, it'd have to move an insanely large, that would be just a massive move on the $CAD for you to, if you put up 70 pips, it'd have to move 140 pips, which is almost triple what the expected move is on it. Okay? And just not really something that you would expect on a day-to-day basis to actually happen for you to be able to go in and place a trade like that and actually have it work for you. So that wraps up the $CAD trade. $70 is about $60 to $70 what you're looking for on the Iron Condor. You want to keep that number under 40. As tight under 40 as you can for a straddle, but I really prefer the Iron Condor on this trade. All right, we'll be back tomorrow, or not tomorrow, we'll be back right after this break. We'll cover Greeks. Stay right there.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization deviation capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome on back here to the Diagnostic Trading Hour, and I'm checking out where the market is right now, what's going on. Okay, so let's go ahead and talk about the Greeks. Moving on to a different topic here, we're going to go into the Greeks a little bit over on the options, and I had a nice little ETC trade there over on gold as it was moving on down. And, yep, just using volume, just volume expectations. All right. So let's see here. Okay, now I'm going to dive into, I want to pull up for you the S&P. I've talked about this a couple times before, but I really just want to focus in on it so you can sort of, pick up what I'm putting down here. How small can I make this and it still be readable? Okay, that right there. Okay. So we have that piece. Now we're going to go over here and let me pull up this right here. And so we're looking at the S&P. So a little reversal trade there. It popped against me, popped on up, take a P3 long. It's going to act quick, take the next trade as soon as it happens. But let's go over here. Let's look at the next piece, which is going to be the diagnostic scanner. I'm going to pull that one up. Okay. And that ought to render over here in a second. Let's give it a second to look on, be on the screen there. And I'll just pull up the binaries for this first part of the lesson here. Go in. And we're going to go down here. We're going to select just the S&P. Okay. All right. So, and I'll just do a screen capture. And we're going to go down because what we really need to look at to compare the two is because what we're looking at options that expire on Friday on the S&P 500 futures. Okay. So we need to look at the weeklies on the US 500. So which we got right here. And take a screenshot of that. So we just lock down the prices so everything's not moving on us every 5 seconds. And now that we have that piece up, then what I'll do is bring this on top, put it up here, and now we can start making some comparisons. What I'm looking at right here, and to help you understand this, is the first thing I want you to notice is we'll find, let me just find a similar strike. So we'll find, see, 1855, 1856. Okay, that's pretty close. And let's look over here and just connect that 1855 and 1856. And I want you to look at the call delta. Okay, so right there, the call delta. And notice it's 8. We got 7 and 1. Basically, bid-ask spread, all that fun stuff. But pretty close. I mean, right there at $7, 8 delta. We're right on that. So the delta is very similar as the binary strike's price. Okay, 1855, 1856. Obviously, if it was 1855, it could be a little bit different. But, try to get as close as we can to try to find it. It's easier whenever we get them to line up like perfectly, but that's pretty close. 1844. So let's take that. Let's bring that over to the 1845s. Okay, see how we got 16 and 1650. So the price is the same as the calls delta on the S&P E-mini. The binary's price is the same as the calls price. Okay? Let's see if it happens again. 1820. Look at 1820. Okay, right there, 51. Pretty much the bid-ask average right there, 51. Price is the same, approximately the same as the delta on the exact same strike of the S&P. So the binary's price of the 1820 is the same as the delta of the call on the S&P E-mini's 1820. Are you seeing the pattern here? Okay. Let's look at 1784. See if that'll even work. That's pretty far out there. 1784, 1785. That was actually a little bit off. There might be some. Oh, well, I don't know. What do we got? We got 90, 86. So it looks like their delta's a little bit skewed up here. So we got 86, 88, 77. So it looks like their delta's actually sort of off over there. Probably a lack of volume, lack of last trade. One of the ways to see where you're going to see that skew is see where you're seeing the gray. Let me highlight this, make it a little easier. Like right here on the pricing. Pricing hasn't really changed on these right here, like this one right here. So you really, that's not going to be accurate for looking at delta on, because you need to really an accurate recent quote for the delta to be updated. So that sort of invalidates looking at these right here. There'll be a lot more activity on them tomorrow. Also more activity on a Monday. So those right there, there's just been no price activity, so we really don't have anything going on. Well, let's see, is there anything else? And that's really most of the strikes that we're going to be able to see right now to be able to look at the delta. But, and I have examples that I brought up before where they've almost all lined up, because some days are going to line up, some days are not, where they've pretty much almost all lined up. And what I'm trying to get you to see is one thing. The delta of a call with the same expiration and same strike is the exact same as the price of a binary with the same expiration and the same strike. Exact meaning within a few bucks, because there's bid-ask spread on a binary because it's a tradable instrument. Essentially, you're trading delta when you're trading binaries. Okay, that's what the price is. It's the delta. So instead of buying the call, you're buying the delta of the call. That's what it is. What is delta? What does delta mean? It's pretty simple. Delta means how much will the option change in value for a 1 point move in the underlying market. Again, how much will the option change in value for a 1 point move in the underlying market? So, if I bring up something over here, maybe I'll bring up an Excel sheet for you. Makes it not hurt as bad whenever you see it in front of you. The first lesson we want to pick up on this is if I'm going in and just to put it in stock terms, okay, let's say I have a stock that's priced, stock price is currently, we'll say, at $100. Okay? So $100 is the value of the stock. And then let's say I have a delta of 0.5. Or you could just say, well, let's say 0.5. And the stock goes, up $1. Or the stock goes down $1. So now the stock's at 101, or the stock's at 99. Now I have a delta of 0.5. Now let's say that's on a at the money strike, okay? And the strike being at the money means it's a $100 strike. And the price of it, we'll just make it easy. We'll just say it's $1. Okay? So just trying to keep it really simple. Per option. Now there's like 100 options in a, strike and all that. Doesn't matter for understanding Greeks. $1 is the cost of the option. Like there's $1 premium in there. Okay? Because it's, it's right there. Why is the delta 50? The delta, or 0.5? The delta is 50 or 0.5, however you want to phrase it, because there is a 50-50 probability of that option being in the money or out of the money. And so anytime that an option strike is the same as where the market is, the delta of that option will be 50. That's why we saw on our example, with the market being at 1820, right up here, market's at 1820 whenever this is going on, and we can see that the delta right there is 51. We can also go over here, and we can see, the 1820.5. The price is also right at 50, plus or minus, bid-ask spread. So delta is a reflection of probability of expiring in the money. Okay? Doesn't mean you have to hold its expiration. It's just probability of expiring in the money if held. And I just wrote an article for Yahoo Finance talking about the top mistake binary option traders make, and that's holding to expiration. Like, you don't do it as an option trader. You don't hold the last trade date or delivery date as a futures trader. You don't hold till the stock company buys back your stock. Why would you hold a binary till expiration? Anyway, so delta of 0.5, and we got the at the money strike, $100 strike, $1. What happens when the stock moves up $1? Well, if the delta is 0.5, what is delta? Delta is, again, how much the option will change in price for basically $1 move in the underlying. Okay, so if the stock went up by $1, my delta is 50, then my option should actually increase by, let's just say this was a call. Okay, so we'll just say call. Make it easy. To $1.50. Because it increased by 50 cents when the stock increased by $1 because delta is 50. Okay, so it's going to increase by 50 cents per option. Now, if it went down, I'd lose 50 cents. It'd go down to, 0.50. Okay? That's delta. That's all delta is. There's nothing magical about it. There's nothing super complex about it. That's what it is. It's derived from the price, basically saying how much should this option change in price for a 1-point move in the underlying. Okay? So, once you understand that, you got delta down. And when you start looking over here at the binary price ladder, you start going, okay, so that's delta, and that's how much the price changed, in this case, for a 12-point move in the underlying. Okay? So you could take the difference. This wouldn't be an exact science. You could take the difference, and you could divide it by 12, and basically have an idea of the delta for every 1-point move in the underlying. Such as I could go in, and I could grab a calculator. And again, this is not the exact math and the exact science. It's just to make sure you understand the concept of delta. And so I could look at 1832.5, okay, minus 1820.5, okay, 12 points. And then I could look at, okay, 53.5 minus 33, that's 20.5, divide that by 12. Basically, for every point that the S&P moves, the binary is going to change $1.70. Okay? So, pretty simple. About a 1-point move should be about $1.70 change in the binary's contract value. Now, of course, I got to account for bid-ask spread. The delta is actually going to increase and go faster and slower. But that at least gets to point the concept of how much should I expect, at a change in pace there on the delta. Once you get down the concept of the delta is simply, or the binary is simply how much the price of the delta, the price of the binary changes for a 1-point move in the underlying market, then you go, okay, well, what happens after that first point? Oh, well, the delta changes again. Okay? So how much does the delta change by? Because it can't remain at 0.50. You can't keep making 50 cents and losing 50 cents because you'll end up going negative. Okay? A delta can only go down to 0 and can only go up to 100. Does that sound familiar? It's just like a binary contract. Down to 0, up to 100. So what you have next is you have what's called gamma. Okay? Gamma is how much the delta changes for every $1 move in the underlying. So, if we go over here and we had a 0.5 delta, but let's say at the same time, let's say we had a gamma of 0.2. Okay? So there's our gamma, and there's our delta. Well, that means that the delta is now going to be 0.7 and 0.3. We're going to add 0.2, 1-point move on the new delta, and we're going to subtract 0.2 on a 1-point move down, which will affect our price again. So after the break here, I'll connect the dots on what that means for a binary option. Stay right there.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Join David Dwight as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, come on back here to the Diagnostic Trading Hour. And so just checking everything out. And we're going through, delta and gamma and talking about it, putting the pieces together. So right here, if I have a delta of 0.5 and a gamma of 0.2, when the stock moves up $1, my delta increases. It's on a call strike to 0.7. My delta would decrease to 0.3. Okay? And again, call delta is the same as binary price. Okay? And what I want you to notice here is, of course, notice how, of course, it gets bigger and bigger, but eventually it'll cap out at 1 on your delta. We got $1, $1.50, $2, $2.95, and it goes down. So there's a couple cool things to notice. One is, notice, obviously you make money faster as it goes up. So the price literally is going up. The delta is getting larger, so you're making more and more money. As it goes against you, the delta is going down, so you lose money slower. Okay, like here we're up almost 300%. So versus being down, I guess at most you could be down 100% on this. Okay, so just understanding that concept of delta speeding up. But I also want you to notice something that's really important. There's basically what I call getting in front of the gamma curve. We start at 0.2, we go down to 0.1, 0.05. See how gamma slows down the further in the money you get? Okay? Whereas if I start a little bit out of the money here, check out how gamma speeds up. So if you want to get that maximum price acceleration, you're actually going to get it looking at, say, like a 30. Because notice, like right here, we only get we have a very small gamma. We only get a change of 0.025 to 0.3. Remember, this is like binary price, okay? 0.25. So, and understanding that, when you go into it and putting all the different pieces together, then, and I'd have to, obviously I got to change up the math on all this and get it all perfect and everything. But the idea is you have a very small change, but then all of a sudden you have like a big change in your gamma. It gets faster, which means your binary goes from like 25 cents to 30 cents. Okay, $25 to $30 in a 1 point move. Only a $5 change. But then it goes from 30 to 50 in a 1 point move. A $20 difference in a binary. And then it goes from 50 to 70, another $20 difference in the binary. And then it goes from like 70 to 75, only a $5 difference. So if you get in front of that gamma speed, that's actually where you're going to make the most money in the shortest distance. You'll make more money from 99 to 101, a $2 move, than you will from 100 to 102. Okay? And, it's basically, this, and if we just looked at this on, the pricing here, that's for every 50 cents I made $1. Okay, for every $1, I made about $2 if I went, actually no, I only made $1.20 on the $2 move. So, we'll just draw off these top and bottom ones, I'm just confusing things. But for right here, so 50 cents, doubled my money. Okay, I guess tripled the money I have now, but I have made $1 for every 50 cents I put in. For this, I only made $1.20 for every $1 I put in. And or you could say, if you wanted to equalize it out, you could say for $1, I now have $3. Versus for $1, I now have $2.20. Why? Because I was in front of the gamma curve. When you understand that idea of that gamma curve, and you don't have to understand like all the math and get all like technical and mathematical and algorithmic and quantitative, just look at the strike ladder and see where the rate of change occurs. And we see, look, what's that maximum return binary? We have that on the simulator on the scanner. Get the one right before it, and you'll maximize your profits in the smallest possible move. I'll go into some more depth on this tomorrow. We'll talk about different expirations and the gamma curve with that. Stay tuned. We have another great show coming up for you right after this.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
You're watching Tiger TV.